Now speaking, Jill Sawyer, Vice President, Investor Relations. Good morning, everyone. Thank you for joining us on our second quarter 2023 earnings call. Prologis had a strong quarter, with total revenue of $1.2 billion, up 8% year-over-year. Funds from operations, FFO, was 86 cents per share, up 10% year-over-year. Earnings before interest, taxes, depreciation and amortization, EBITDA, was $1.1 billion, up 9% year-over-year. We also saw strong occupancy growth, with our portfolio occupancy increasing to 95.3%, up from 94.7% in the prior quarter. Our leasing activity was robust, with new and renewal leases totaling $1.3 billion, up 11% year-over-year. We also saw strong demand for our development projects, with $1.2 billion in new projects started in the quarter. We are confident in our outlook for the remainder of the year and are raising our guidance for FFO and EBITDA. We look forward to continuing to deliver strong results for our shareholders. Thank you for joining us on our second quarter. Now speaking, Tim Arndt, Chief Financial Officer. Good morning, everyone, and thank you for joining us on our second quarter earnings call. We had a very successful quarter with strong results across our diverse business. Highlights include record rent change, a ramp-up in development starts, and the acquisition of over $3 billion of real estate at accretive returns. Core FFO, excluding promotes, was $1.25 per share and including promotes was $1.83 per share, both ahead of our forecast. Average occupancy for the quarter was 97.5%, down 50 basis points from the first quarter and in line with our expectations. Rent change on starts was a record on both a net effective and cash basis, 79% and 48%, respectively. Net effective rent change on signings was an impressive 87%. Same-store growth was exceptional at 8.9% on a net effective basis and 10.7% on cash. We raised approximately $7 billion in debt financing across four currencies at an interest rate of 4.9% and an average term of 8 years. We are watching markets closely and expect vacancy to reach the mid-4s in the U.S. by year-end, but continue to believe that fundamentals will regain momentum in 2024 with the outlook for new supply declining as development starts continue to fall this year. We are increasing our same-store guidance to 8.75% to 9.25% on a net effective basis and 9.5% to 10% on a cash basis. Net effective rent change propelling same-store should continue to accelerate in the next 2 quarters and average approximately 80% over the year. We are increasing core FFO, including promotes guidance to a range of 5.56 to 5.60 per share and increasing core FFO, excluding promotes, to range between 5.06 and 5.10 per share. We are increasing guidance for GAAP earnings to range between 3.30 and 3.40 per share. We have 2 upcoming events later in the year, our Groundbreakers Thought Leadership Forum on September 27th and our Investor Forum on December 13th. Thank you for joining us today. PIG analyst Tom Catherwood inquired, Tim, have you adjusted your projection for U.S. rent growth? Can you provide more detail around markets or regions where rent growth and values have exceeded expectations? Are there any that have lagged your expectations? Tim Arndt replied, Tom, the U.S. market is in a similar range to the global market. The main market that has been downgraded is Southern California, but this is being offset by other markets in the Southeast U.S. and globally, keeping the average close. Wells Fargo Securities analyst Blaine Heck inquired, what factors are driving the downward trend in lease proposals and do you expect an inflection in the second half? Chris Caden replied, when looking at the data, it's important to consider our open availabilities. Historically, we've seen an average of 48%. There are 3 drivers that explain why the proposal numbers are in line or above this average. Firstly, the availabilities for the next 12 months are lower than usual. Secondly, multiple proposals on a single unit have decreased over the last year. Lastly, there is some seasonality with June being a softer month. Citi analyst Craig Mailman inquired, could you provide more insight into the 200 basis point drop in U.S. market rent growth? What were the biggest moving parts? Additionally, what is driving the 80 basis point sequential decline in occupancy, particularly in SoCal, New Jersey, Central Valley, and Atlanta? Tim Arndt replied, rent growth and occupancy are key metrics for our business. We're pleased to report that we've been able to hold our forecast in a tight range and our average same-store occupancy guidance remains unchanged. We expect the decline we have previously forecasted to continue. Hamid Moghadam replied, we're not seeing it in the occupancy numbers yet, but we are seeing it in the rent growth that we're getting. We're seeing a nice uptick in the rent growth that we're getting and that's what we were hoping to achieve. I'm pleased to report that our efforts to push rents have been successful. We've seen an increase in the percentage of deals lost due to price, from 10% to 20%, which is where we'd like it to be. This has resulted in an uptick in rent growth, which is what we were aiming for. Goldman Sachs analyst Caitlin Burrows inquired, can you provide more details on the potential causes of the lagging market in Southern California and how long it could last? Hamid Moghadam replied, Southern California is being adversely impacted by the prolonged labor strike at the ports, which has caused companies to shift their volumes to other ports. This could cause permanent damage to the region. Additionally, the high rents in the area have caused more price sensitivity and people are shifting to adjacent markets. With a more normalized vacancy level and the resolution of the labor strike, we should see a more normal pattern from which we can draw conclusions. Evercore IC analyst Steve Sakva inquired, Hamid, could you discuss the demand for tenants by size and any disparities you're seeing? What is your confidence level around development starts for the second half of the year? How many projects are currently teed up and what does the split of starts look like between the third and fourth quarters? Hamid Moghadam replied, we are not focused on development starts or acquisition guidance. Our main driver of earnings is rental growth and same-store NOI increase. We can model a scenario with zero rent growth from here on out and still achieve low double-digit earnings growth with our current leverage. We will start development projects when it makes sense to do so, but we won't jeopardize our pricing power by trying to meet an artificial goal. Dan Leder replied, yes, we are seeing strong demand across all size ranges. There are some areas with higher risk of bulk development, such as South Dallas, North Fort Worth, Indianapolis, and West Phoenix. However, our portfolio is well positioned to remain insulated from this risk. We are confident in the continued demand for our services. Truist Securities analyst Ki Bin Kim inquired, what factors led you to choose the $3 billion Blackstone deal over other opportunities such as buybacks or development? Do you believe the value per square foot will remain stable? Hamid Moghadam replied, we acquired a portfolio of properties at a discount to replacement cost. The construction costs have risen significantly in recent years, making this a great opportunity for us. The quality of the portfolio was very close to our own and we did not dispose of any of the properties. We believe it was a market rate transaction with an 8% IRR in a low inflation environment, plus additional upside from essentials and other investments. UBS analyst Michael Goldsmith inquired, what factors have caused the lease percentage of the development pipeline to drop to 2019 levels, and how does this affect expected yields? Hamid Moghadam replied, I believe we are back to 2019 pre-COVID levels. Demand, supply, and rental growth are all trending in the same direction as they were before the pandemic. If someone had told me in 2019 that in 2023 we would still be discussing the dynamics of the 2019 market, I would have been ecstatic. This is the same answer for 20 other parameters. Robert W. Baird & Company analyst Nick Thillman inquired, what is the impact of competitors offering lower prices on tenant retention, which has dropped to 70%? Where are those tenants going and is it due to pricing or other factors? Hamid Moghadam replied, no, warehouse rent is not a major factor in businesses going out of business. In fact, it's a relatively small percentage of total logistics cost. The bigger concerns are energy prices, fuel prices, and labor costs. 70% retention rate is not unusually low, it's actually normal for us over the past 10 to 20 years. We're trying to find the efficient point for losing customers due to price, but we don't want to push rents too hard. If the retention rate gets to 30%, we may want to moderate on that. Generally, our bias is towards pushing rents and not occupancies, but we make decisions day-to-day based on data. Morgan Stanley analyst Ronald Camden inquired, what was the first half market rent growth, and what should we expect for Southern California in the second half? Hamid Moghadam replied, the most important factor in Southern California is the gas in the tank, which is well over 100% on average leases. While there may be some markets where rental growth could slide, Southern California is still a strong market with embedded mark-to-market of over 100%. We don't spend a lot of time looking at individual rents, but rather make our long-term investment decisions based on macro bets. RBC Capital Markets analyst Michael Carroll inquired, Tim, last quarter you said the 2024 lease expirations had an 85% mark-to-market. Does that estimate reflect expected market rent growth in 2023? Does the 85% target still hold? Timart replied, we anticipate market rent growth to be in the 80s. We feel confident that we will hit that number, and will provide full guidance later in the year. Hamid Moghadam replied, I can confirm that the number we previously provided is still accurate. Bank of America Merrill Lynch analyst Camille Bonnell inquired, can you provide an update on the expected NOI growth for the remainder of the year? How have market rents grown in line with expectations to date and what is the projected pace of growth for the rest of the year? Timart replied, I want to be clear that same store is a much shorter-term metric. It's really about what's happening in the current quarter, and it's more of a snapshot of what's happening in the market right now. So, while we expect to see 8.5% average rent growth, Hamid Moghadam replied, the average same-store NOI growth for this quarter was positive. Hamid Moghadam replied, rent growth is a volatile number, so I don't have it on hand. Timart replied, yes, the number incorporates the fair value lease adjustments and occupancy for Duke. This year, there is very little that could change in terms of market rents that would affect same-store growth. The lease mark-to-market in the year are now set, so we expect to stay within the range we have projected. Chris Caden replied, the rent growth detailed in our script reflects the pricing power and market rents we're seeing across the U.S. and globally. However, the aggregate number is adjusted downward due to the impact of Southern California. BMO Capital Markets analyst John Kim inquired, how much did the $3 billion acquisition contribute to your full-year guidance raise? Can you comment on the pricing and competing bids at that level? Timart replied, roughly 5 cents of our raise is due to earnings, with the remainder coming from same-store sales. Hamid Moghadam replied, we worked collaboratively with the seller to select a portfolio that was beneficial for both parties. We didn't have to go through a competitive bidding process, as two of the largest players in the space are well aware of market pricing. We were able to come to an agreement quickly and we're pleased with the outcome. We got what we wanted at the price we wanted, and the seller got the price they wanted. Everyone was happy and we'd love to do more deals like this. Scotiabank analyst Nick Ulico inquired, what is the activity of 3PL tenants across your portfolio? Hamid Moghadam replied, Southern California is a market with embedded mark-to-market rates well over 100%. This means that 3PLs, which are low-margin businesses, can make 3-4x more money by subleasing their space than they would by moving boxes around. This propensity to adjust space to needs is much greater in this cycle due to the high mark-to-market rates. In other markets, where mark-to-market rates are lower, subleasing is more of a cost avoidance and therefore not as common. Southern California has been a crazy rent growth market for the past few years, but it's not sustainable and we don't make our investment decisions based on that. Mizuho Securities analyst Vikram Malhotra inquired, what is the trend in square footage of lease expirations compared to the size of the portfolio, and what is the risk premium for public-private warehouse space? Hamid Moghadam replied, in 2019, vacancy rates were above 5 to 6%, but today they are substantially lower. We have less concern about supply exceeding demand than we did in 2019. We continue to trade at a modest discount to NAV and private values, and I believe that will be validated once capital flows start up again and public markets improve. Dan Leder replied, Vikram, regarding proposal volumes, it is square footage. I previously answered the same question and am happy to discuss further offline if needed. KeyBank Capital Markets analyst Todd Thomas inquired, what is your expectation for the spread in market rent growth between coastal and non-coastal markets by 2024, and which coastal markets are being impacted by labor strikes? Hamid Moghadam replied, Southern California is projected to have the highest rent growth rate of all markets we operate in for the next 5 years or more. The mark-to-market is significant and can last for many years. However, the market rent growth is not as important as it may seem, as it only adds a small percentage to the overall number. I'm not sure of the answer to your question, but if I did know, I would certainly share it. Barclays analyst Anthony Powell inquired, can you provide an update on the progress of restarting contributions in the US and Europe, and how they are progressing overall? Hamid Moghadam replied, we stopped contributing to our funds due to a lack of clarity around the values of the properties being contributed. We didn't want to make decisions that we couldn't look our investors in the eyes and justify. However, now that there is clarity around the values in the markets we mentioned, we expect contributions to continue at a normal or slightly modulated pace. Chris Caden replied, no, I think that's right. We will likely assess contributions in Q4, taking our time and dividing them between Europe and the US as part of our normal operations. JP Morgan Chase & Company analyst Mike Muller inquired, are you seeing any traction in dispositions in the third quarter? Hamid Moghadam replied, we have almost completed disposing of the Liberty portfolio and only a few dispositions were associated with Duke. We recently sold a couple of them. The latest Blackstone portfolio has no dispositions. Other than the normal Bluebird dispositions, we are nearing the end of cleaning up the portfolio. There may be a few deals here and there, but overall, we are close to completion. Chris Caden replied, I'm confident that the transaction market is opening up and will be able to dispose of our assets when needed. Hamid Moghadam replied, it's not a significant amount, it won't have an impact on our company. Citi analyst Nick Joseph inquired, what were the key factors that drove your decision to acquire the Blackstone portfolio? Hamid Moghadam replied, we have conducted extensive analysis and research to identify the markets that we believe will be most beneficial to our business in the long term. We have taken into account customer demand, supply trends, and legislative developments when making our decisions. We are willing to accept a lower yield for these markets due to their potential for growth. Wells Fargo Securities analyst Jamie Feldman inquired, what are your thoughts on the different regions coming out of a potential recession, and how might macro trends affect capital allocation across Europe, Asia, and North America? Hamid Moghadam replied, U.S. rent growth has been the highest of any market due to its dynamic economy and larger GDP growth in Europe. In Europe, land is metered out by government authorities, resulting in more muted growth. We mitigate this difference by employing a fund structure. China's economic growth has been slower than expected, and it's unclear if this is a short-term or long-term trend. Japan is the best long-term market for development, with low rent growth and no cap rate expansion. Cash flows in Japan are strong due to minimal capex and other costs. Each market plays an important role in our overall business. Bank of America Merrill Lynch analyst Camille Bonnell inquired, "Does the valuation of your USLF fund reflect a recent portfolio acquisition?" Hamid Moghadam replied, "Camille, great question. We purchased the portfolio on our balance sheet, so it's not a fund investment. We bought it at a consistent valuation to what we expected this quarter, and the market has adjusted accordingly. We believe we are at the tail end of those adjustments. Thank you for your interest in the company. We feel confident about our business going forward and look forward to speaking with you more over the summer."